Is that really the smart thing to do, to be unwinding some of that regulation, especially given the scale and the magnitude and the damage of 2008?
Regulators don't need a rule to look at the bond market and the damage it could do. And I look back to the UK. Every single deposit-taking institution in that country needed to be bailed out. It wasn't because of the rules. It's an attitudinal thing. And it was about attitude that allowed Royal Bank of Scotland to fail. I'm sorry, but it was not regulatory rules.
Welcome to You're in Business. We're joined by Bob Diamond, founding partner and CEO at Atlas Merchant Capital. Bob is a heavyweight in global finance, and until 2012, he was the chief executive of the British banking group Barclays. Bob, welcome to the show.
Youssef, it's great to be here, and it's great to see you in your new role. I love it. Or your new business.
Thank you very much. I think we start off with the controversy in the global debate, and specifically Elon Musk, fresh out of the headlines, and the tweet, or on X now, saying that the one big beautiful bill is a disgusting abomination, right? Reflecting his dismay. How concerned are you, Bob, about the fiscal plans? I mean, there's a little bit of truth to Elon Musk's frustrations, isn't there?
Yeah, and similar to, I guess the feeling that many people have with the current administration is most of their initiatives do have something that's important and something of solid truth, but it comes down to execution and it comes down to focus. And I think, listen, there is a very large, how bullish I am on the U.S. economy. You know how positive I am on the very diverse financial services industry in the U.S., how both of those things have been so impressive in the economic recovery since COVID, the rise in interest rates. There wasn't a recession, inflation came down. But there's that dark cloud, which is now getting more attention, and that's the debt bubbles. And I think, part of the issue around this bill is, what does this do in terms of the overall debt level for the United States? If we go back 8 years and look at the first Trump administration and the Biden administration, in those 8 years, we doubled the outstanding debt from 17 trillion roughly to over 35 trillion roughly. And yet that was a period of a pretty solid economy.
Yeah,
so what incentive? Yeah.
Yeah, I look at the tweet from David Rosenberg just to pick up on what you were talking about in terms of the debt levels. And we had this downgrade from Moody's recently, right? Because of what they see as an unsustainable fiscal path. And he said he was surprised by this shrugging of shoulders that we saw in the markets by this decision. The first time ever, the bonds of the world's reserve currency are no longer rated AAA by any major ratings agency. Could we see more rating downgrades? Is this the beginning maybe of a downward spiral, or is that a little bit too pessimistic?
In my own view, what the rating agencies do, I don't really pay attention to as much as what the investors do. And I think in terms of that market, they're much less reliant on Moody's than they are on their own analysis. And I think the debt levels as part of that decision and the overall credit of the United States is appropriate. I mean, I think it should be taken into account. The optimist in me says that more attention around the debt bubbles are very, very good and positive for the United States of America. We have to deal with this. We can't ignore it. And I think my worry, Youssef, is the opposite, which is it's not being addressed. And therefore, the next president, the next president, and the next president feels that this kind of deficit spending and building up of the debt levels is okay. It's not okay. We need to address this.
The numbers are just astounding. So we're $36.2 trillion as of June 1, 2025 on the total national debt. So what are your options then realistically? I mean, either you inflate that away or you cut spending meaningfully. And we're seeing this battle play out in real time between politicians and the bond market primarily. Obviously, there are other asset classes as well in this. But who's going to come out a winner, or do you think it's going to be sort of a bit of a compromise that both can work with?
So the real focus here has to be on cutting spending and driving growth. And if we can get spending down and growth up, obviously those two things are great. It begins to work down. But that's the political challenge in the United States, is where is the political strength to make those tough decisions?
So would you say the bill in its current form is not the right solution then to the problems that we've just discussed, to a sustainable fiscal path? I mean, clearly it isn't.
I think the problem is more general than that, which is I've seen nothing from the current administration that suggests that they have a priority on the deficit levels, or the debt levels, and that during this administration, they're going to come down. I'm not, detail knowledgeable about the specific bill, but I can tell you the feeling of the markets is that this bill, but more importantly, this administration, is not as focused on the debt levels as we would like. And I think that's what we're seeing in terms of the dislocation in the treasury market, the dislocation certainly around in bond yields.
With all the noise that is playing out and all the uncertainty, does it even make sense to buy U.S. treasuries today? Would you buy U.S. treasuries today?
Absolutely. Do I worry right now in the stability of the credit of the United States? There's a lot bigger worries than that. That doesn't mean we don't need to start to address the debt levels. As you said, they're over double what they were 8 years ago. So no, I'm not worried at all about buying U.S. treasuries, nor should anyone be. But the sooner we get going on addressing this issue, the more sound the economy in the U.S. will be. I think people talk about the impact on the dollar. I think it's a legitimate concern for all the reasons we just said. But let's be honest, there's not a legitimate alternative. So the dollar is still the reserve currency. The risk-free rate is still pegged to the U.S. Treasury market. And I don't think a lot has actually changed there. But I think it's a very, very, very positive development that this is getting attention.
I mean, Jamie Dimon is concerned, right? He was speaking the other day, and he says that even though he sees JP Morgan as safe from what he described as a crack in bonds, he does see a problem there. And it raises a bigger question on when you have these kind of cracks like we had with the 2013 taper tantrum, we had the COVID liquidation. I mean, even the bigger institutions like JP Morgan would not be able to get around a proper crack in the bond market. Can we agree to that?
Well, I think what Jamie was talking about is a crack in the bond market writ large, which is that we've had a period of real stability, both in equities and in bonds in the U.S. One of the reasons that they refer to a business cycle as a cycle is because it's a cycle. And we're long in the tooth in terms of both the bond markets and the equity markets. And again, I'll come back to it. If we get some serious crack or serious dislocation and investors are much more uncertain about the bond market, I don't think it's necessarily negative. If it's all wrapped into the fact that there's more attention coming from this administration, from the population in the U.S., from the focus on the next election, that this is not sustainable and we need to begin to deal with the debt. That's very different, Yusuf, than saying I wouldn't buy treasuries or there's a crisis today. I do think that Jamie's correct to say watch for a crack in the bond market, but I don't think he's saying we're about to see a 2008.
At the same time, I look at your comments on tariffs in the last 3 to 4 months, and you've been very clear, you've been very critical, and we've gotten more, not less of them. And there's a huge amount of uncertainty in the policy decisions. It depends what day of the week it is and what mood the administration is in. And it's really hard to make any decisions like that, either as a consumer or as a top executive at a large institution. How much damage has been done from tariffs on the reputation of the United States as a destination for global capital, Bob?
Spot on. It's a very good question. And I can tell by the way you asked it, what your view is. And I would agree with you that I think there's two very, very specific issues here at play. One is, are punitive tariffs an effective economic tool? And you've heard me speak on this. No, I don't think so. If you're asking Bob Diamond, no. I think that tariffs, when it's to equalize trade, for example, if China is subsidizing certain industries, if they're very targeted to industries, to certain things that are imbalancing trade, they can be part of an overall trade package. But we've moved into punitive tariffs and threats. And I think that feeds into your second point, which is our relations with our allies. And I think the change in the relationship between the United States and Canada, the change in the relationship between the United States and the United Kingdom, or most of the major European countries, is an issue. And it's not helpful for us right now. So I think when you take those two things together, what the implementation of the tariff programs has been very negative, both for our brand and reputation, which leads into interest rates, right? And equity investment. It has been very negative in terms of solving the issues, which I think are really the core issue here, which is there was a serious imbalance of trade between China and the U.S. And in my mind, let's focus on that and let's stop all the punitive tariffs with Sri Lanka and Vietnam and the UK and areas where it's not necessary.
The rhetoric is just getting a little bit out of control. I mean, the latest comments from Donald Trump accusing Beijing of violating the agreement reached in Geneva, and China hit back almost immediately, saying that the U.S. government has, this is a direct quote, unilaterally and repeatedly provoked new economic and trade frictions, exacerbating uncertainty and instability in bilateral economic and trade relations. What comes next, Bob? I mean, we can't keep going like this sort of tit for tat and tit for tat all the way out for the remainder of this administration. This is going to be I'm already exhausted, and we're barely a few months into this.
Well, listen, I have been optimistic for so long. I've earned the moniker optimistic. So I'm going to stay optimistic. And I think the optimism I have is that there are real fundamental differences between China and the U.S. on our trade relations. I think change is necessary in that relationship. And I believe strongly that it's in the best interest of China and the best interest of the United States that we resolve these in a way that is supportive and fair, and works for both sides. So I'm optimistic that we'll get there. If you asked me, I would not suggest kind of the public debate is the way to get there. I would, expect the leaders, to get on a plane, to get somewhere together, and to start working on the fundamental issues. Because frankly, there are so many analysts that have put out reports on this. It's not that hard to figure out where the imbalances are and start focusing on those and correcting them, which would be in the best interest of both China and the U.S. So I'm going to remain an optimist. I think we'll work this out. I don't like the execution of it right now. That's my opinion. But if it gets us to the right place, maybe it's okay.
So is this going to be another taco situation then? Is that what you're hinting at?
I believe that the negotiating style, as our president has always talked about, is to come hard and then so we have to separate what is just backing off from kind of a negotiation. But I think you're coming right back to what I'm saying is we don't need to do it in public. We should have serious meetings going on between the operatives in China and the operatives in the U.S. And let's get to the fundamentals and get out on the front page of the newspaper.
Yeah, I hear what you're saying, and it makes a lot of sense. And
it's not going to happen,
maybe they should give that a try if sort of the outright force of forcing everything through posts on Truth Social and X hasn't been working. I want to get to something you were talking about, and it's really important. So I need to flesh it out with you. And it's this concept of, because you were saying, you know what, you're not afraid to buy US treasuries, which is fine. It's not about whether you're going to get your money back. It's like, what is your money going to be worth the moment you get those treasuries back? Because at the trajectory we're going at, it's not going to be worth much in 10 years or 30 years or whatever the 10 years of the paper you're buying. We've had previous cycles of US dollar weakness, sure. I'm thinking 2002 to 2008. The dollar index went from 120 in 2002 to about 70. So we're talking about a 40% decline. Have you moved out of the US dollar into other currencies because you're expecting another big drop, at least in the short term?
Listen, we don't make our investments. We're investing in financial services, and we look at the US, the UK, and Europe. So we really deal in three currencies: the dollar, sterling, and euro. And we've never made an investment decision, nor do I think we will, because of the currency alone, or even as that is a major issue. We don't ignore it. And then once we've made an investment, we're very cautious on whether or not we hedge the currency, because our investors are investing, even those that are international, they think of us as a dollar-based fund. So we can't ignore that we have exposure to the euro and the sterling. But let's be honest, these aren't hugely volatile currencies relative to the dollar. What happens actually is somewhat different than that. And this has been very interesting. Two of our portfolio companies, we're a large investor in Kepler Cheuvreux, which is a Paris-based European equity sales trading research, outstanding, very high volumes, right below the bulge bracket, tremendous business. Mm-hmm. Absolutely record flows in the first quarter of this year from U.S. investors into UK and European equities.
Interesting.
The most they've ever seen, and certainly since 2008, we've seen nothing like this. We've seen more of our Middle Eastern investors in Atlas Merchant Capital have been risk off on Europe for the last 5 or 6 years, almost since before COVID. So they haven't seen it as a great area to be investing. They haven't said no, but the barrier is much higher. That's changing. And I think, one of the benefits of some of the things that we have been talking about that have been negatives is that it's put a little bit of a boot in the butt of Germany and in France and in the UK and some of the large economies in the UK and Europe that, quite frankly, have to focus more on business, on success, a little bit less on social issues and a little bit more on business issues. I'm not saying the social issues aren't important, but my goodness, they have been so lagging the U.S. in terms of productivity, in terms of profitability, and we've seen it more than ever in the large banks in Europe since 2008 and the UK versus the U.S. banks.
I want to kind of wrap up sort of the U.S. angle with the Fed Chair Jay Powell, sort of the last leg of that stool, and he put out a statement that's been interpreted as a rare, explicit commitment to its independence from the executive branch. What did you make of it? Were you surprised? The market seemed to be a bit surprised by how candid this statement was, or did you not make as much of it?
One, I didn't make as much of it, and second, thank goodness. The independence of the Federal Reserve Bank is a underpinning of the strength of the U.S. financial system and the U.S. economy. And if it starts being dictated by the executive, we're in trouble. So hats off to Chairman Powell. I think he did the right thing. I think he's been steadfast in his independence. I think, frankly, he took a little bit too long post-COVID to raise rates. But I think he's played a blinder since then, Youssef, in getting rates up to 5.5%, getting inflation down, keeping the economy strong. And I think they'll be very, very cautious about reducing rates from here. That's probably the direction of trade, is another 1 or 2 small cuts this year. But he's not going to do anything crazy because, we need to save, the power of those cuts for when it's required by the numbers, by the inflation numbers, by the economy numbers, by the labor numbers. But right now, inflation remains under control. The labor market is really, really strong on a historic basis. There are some concerns and some cracks for all the reasons you and I had talked about earlier, but the Fed is going to be very thoughtful, very cautious about cutting rates over the balance of this year and next year. And I think that independence is critical to our economy, to our brand, and to the dollar.
Which economic indicator does Bob Diamond watch more than anything else?
That's a great question.
We'll call it the Bob Diamond indicator.
Yeah, I think over the last few years, inflation has been the one that has been most important. And I don't think of this as, so I would say the inflation and the unemployment rates. And I've looked at the unemployment rates in terms of the JOLTS, which is job openings and things like that. I think if you keep an eye on inflation and you keep an eye on job openings, you're really right there focused on the Fed. That's a long-winded way of saying keep an eye on the Fed.
Yeah, I mean, employment and obviously the cost pressures are sort of two necessary sort of data points to navigate the financial landscape. So in that sense, you're mainstream, but you're of course unique in many other ways. I want to speak to some of the alternatives and specifically about major banks letting their clients buy Bitcoin. I appreciate that this doesn't necessarily fold into what you do day to day, but you personally, are you buying or adding exposure to Bitcoin? Do you own any crypto?
So crypto is a word that covers a lot of areas. We have been an investor. I'm proud to say we've been public on this in Circle through a private round in Circle. We tried to take them public through a SPAC. The SEC was absurdly ineffective, I think, in understanding stable coins and understanding the difference between a stable coin and a Bitcoin. I think under the Gensler administration, most people who are investors would say it was a very, very difficult period for any sophisticated investor because of the unwillingness to engage around so many topics and so many strong economic opportunities that just went by the wayside because of the benign neglect from the SEC under Gary Gensler. We're in a much better position today. I think the attitude of the Secretary of the Treasury, the attitude of the administration toward consolidation, such as in U.S. banks, but also we will see the pricing of Circle today or tomorrow in there going public. And I think that's very, very positive. Now, I think when you talk about crypto, Youssef, there's kind of three buckets I look at. There's the technology and the infrastructure, and I'm a big proponent of blockchain. I think, frankly, 10, 15 years from today, it will be the underlying technology in most financial institutions. I'm also very, very positive as an investor in stablecoins. I think the wonder and the strength of Circle is they want to be the most regulated, the most clean. All of their reserves are held at BlackRock or 95% in a fund of one, so a dollar's a dollar. But you would have a hard time convincing me that we're not going to have an institutional awareness and usage of a digital version of the dollar. And it's the job of the Fed to regulate this area, not to approve it or disapprove it, but to regulate it hard. And if you look back, to something as simple as the Fed wire, how we transfer money for the last 4, 5, 6, 7, 8 decades, that wasn't invented or developed by the Fed. It was developed by the private sector and then regulated heavily by the Federal Reserve Bank. Yeah, and I think that's where we're going with stablecoins, is let the private sector develop and let the regulators regulate.
I mean, that was a true transformation for sure. And I know from the Financial Stability Board, I was catching up with the president, and he was making the point that they're trying to unify regulation globally, even beyond the United States, to make sure that you close up any opportunity for arbitrage. The other alternative I want to talk about is private equity. And there was a fascinating conversation between the Egyptian billionaire Nassef Sawiris, who's speaking to the FT, and he said the private equity industry is past its peak, and they're facing massive challenges in selling trillions of dollars in assets. Firms have struggled with exits and a slowdown in deal making and IPOs. I mean, that's not radically new per se, but just to hear that frustration from somebody like him definitely caught the attention of quite a few people. To what extent do you agree with that? I mean, obviously you're on the other side of that, so I expect you not to agree, but if you still have an opinion, I'd love to hear.
It's a yes and no, and I have tremendous respect for Naguib. He's someone that I've known well over the years, and he's very knowledgeable about the markets. But I think on the one hand, you have the very large 10, 20, 30, 40 billion type funds in private equity, which is really institutionalized over the last couple of decades. that use leverage as their primary tool. So the interest rates have a lot to do with it. And the downside is very real when that much leverage is put. What we're doing in Atlas is our funds are $1 billion or a little bit less. They're very, very focused. Like our current fund is on U.S. regional and community banks. We recognize that our investors like opportunities for co-investment, so we don't need a mega fund. We have a fund that is real, but gives opportunity for investors to have co-invest. But mostly, I would say, we're focused on financial services. We rarely use any leverage, never mind 2 or 3 or 4 turns of leverage, because the institutions that we're investing in already have the leverage in them in financial services. So higher rates are typically good for financial services, and we're seeing a lot of interest. As I said to you, we're able to do a first close at our U.S. bank in our fund for U.S. banks, community and regional banks. And literally tomorrow we'll have one of a couple of realizations this year in our previous fund when Circle goes public. So we're seeing it differently, but I think part of that is we're a boutique. We're not a mega. And we're financial services just in the developed economies. And while there are select instances where leverage makes sense, such as in acquisitions, it's not a normal tool when you're in financial services because the leverage is in the institution. So I think like everything, it's a different story depending on what sector. But we think the opportunities in financial services for a fund like Atlas Merchant Capital have never been better.
Quick reminder for our global audience to get involved. Please share your questions and thoughts in the comment section below. We'd love to hear from you. I want to pick up then on the new opportunity set for Atlas Merchant Capital. You articulated this conviction call on U.S. banks, and this is specifically regional banks. How has that worked out so far? Is it too late to get into that today?
You know, it's interesting. Since SVB and First Republic were rescued a couple of years ago, there has been an acceleration in consolidation, but thoughtful, cautious, 10 or 20 transactions, not 500. Regional and community banks are incredibly important to our economy. Over half of the lending, as Secretary Bessent said, half the lending to small businesses and family offices comes from these banks, not the big four. And right now, there's an opportunity to put new capital in this sector and to encourage and support the strong regionals from acquiring some of the smaller, more private community banks that are outstanding institutions, but are frankly just too small to succeed, given the incredible increase of costs of technology and costs of regulatory compliance and costs of KYC. Now, as important as these banks are, 4,500 is probably the wrong number. Not many Americans knew we had 4,500 banks until SVB collapsed.
I thought that number came down. We're at 4.5.
Yeah.
Wow.
And I think we believe in 2 to 3 years, it'll be at 1,000 or 1,500. And we are investing in the stronger regional banks to give them the capital to be able to acquire one or multiple community banks. And obviously, we'll always be below 24.9%, so we'll be a minority. We'll take board positions and advisory positions, but the actual consolidation will be done by the institution, and we will be a support from an advisory point of view and an equity point of view. Eric Rosengren, the former president of the Boston Fed, has joined our team. My partner, David Seamus, who you know, did the IndyMac deal during 2008. So we have such experience. We are so excited because these are strong and important institutions. Putting capital in the market after the interest rate increase from 0 to 5.5% is important. And they're coming out as stronger institutions through consolidation. So this is just a win-win-win. And, being in an investment area, which is very strategic as opposed to opportunistic, means that we can be doing this for the next couple of years and really enjoy this opportunity.
What about the Gulf? I mean, the first time we met, I think it was almost 10 years ago, and it was in Riyadh.
Don't tell me that.
And it was at a big investment conference. And obviously, you've been back many times soon. Are you planning to move permanently? the opportunity set there becomes so appealing that you either create a new office or you sort of shift more of your focus there. Tell me about the Gulf.
So it's a very good question. And I have not talked about this publicly, but there's two pieces to this, and we're very excited about both. The first piece,
I'm all ears,
is every private equity firm like Atlas Merchant Capital has benefited from the huge reserves in the Middle East, whether it's in Abu Dhabi or Qatar or the Kingdom of Saudi Arabia or Kuwait. So far, it's been the investment into Atlas Merchant Capital that has allowed the Gulf to be investing in the US, UK, and Europe. What we're working on more now, and has always been, I remember our first conversation at the first FII conference when MBS really announced Vision 2030, was that we would also like for Atlas Merchant Capital to work in the Gulf. They don't need our equity, but they do need our expertise. We built global banks. We built private banks. We built asset management platforms. And the experience we have can help them in the domestic banking business and, frankly, the domestic asset management and investment banking business and capital markets business. And we think in places like Qatar and like the Kingdom of Saudi Arabia, there's an opportunity to develop local businesses in banking, whether it's digital banking, investment banking, asset management, wealth management, domestically with domestic teams, with the advice of people like Atlas Merchant Capital. And that our opportunity isn't to be global right now, but there is an opportunity to become GCC-wide. In other words, to look at the region as an opportunity for expansion. So we're in a number of discussions there. I won't tell you the country because it would give it away. But I'm spending a lot of time in the Middle East.
Is it the UAE?
And
Is it Saudi Arabia?
It could be. Or maybe it's all of them.
I mean, if I had to bet, I'd say it's more than one.
You're right. And the opportunities are in more than one. But I will say that since you and I met, I think it was exactly 9 years ago at the first FII conference where MBS announced Vision 2030, the changes in the Kingdom of Saudi Arabia from a cultural point of view, a social point of view, the beauty of the hotels, the restaurants, the quality of living has been dramatic. And I was there just a couple months ago. And I think anyone who has not spent time in the Kingdom of Saudi Arabia, in Qatar, in the UAE, really owes it to themselves to get on a plane, get out there and see what's really happening on the ground. It's phenomenal development, not just in terms of the wealth of the countries, but in terms of the culture, the quality of living. It's really, really impressive.
Bob, I want to go to the wider point on the outperformance of US banks versus the rest of the world, versus Europe, maybe specifically since the global financial crisis. There's a quote from you recently saying that the US government invested in banks, but in Europe it was biblical justice. Let's get these, and I'm just going to bleep it out there. Looking back at sort of the European story, which countries have done better than others? Because when we talk about Europe, it's a very wide brush, right? So we need to get a little bit more specific, because you can't say that Switzerland is in the same boat as, United Kingdom, for example.
Well, I would say who's done the worst? I would say right at the front of that is the UK and Germany. It's been pure biblical justice, which is after 2008, let's get those guys. The bankers are bad. The banks are bad. Let's penalize them. Where Hank Paulson in the U.S., Secretary of the Treasury, and Tim Geithner said, the most important thing is, of course, if individuals did something wrong, they're in trouble. They should be. But what's important here is that we have a healthy financial services industry, because that's important to our economy. And so what do they do in the U.S.? They force the 10 biggest banks to take 25 to 50 billion in equity. They charge them an incredible, expensive rate to pay it back. They said you can't pay it back until we approve the stress test, meaning you've cleaned up your balance sheet. And oh, by the way, until you pay it back, which means you've cleaned up your balance sheet, you can't pay bonuses or you can't pay dividends. And at that moment, both B of A and Citibank were insolvent. No different than Deutsche being insolvent or Royal Bank of Scotland being insolvent. But what happened is now today, B of A and Credit Suisse and Wells Fargo and JP Morgan are absolutely killing it. They're much stronger banks than they were. They've been hugely important to the U.S. economy and to their investors and to dividends. Where the UK banks have just faded and faded and faded. And literally last week, 15 years on, the government money was taken out of Royal Bank of Scotland. So I think it's been very, very clear that the focus should be on what's best for the economy and for the people, not kind of let's get even and let's penalize the banks. And now to finish it, two things. It's beginning to turn around, and we're seeing much more aggressive recognition of the importance of banks. And two, Italy, Spain, France, I think their large banks are doing much, much better because the regulators have been more focused on it, on allowing those banks to invest and to expand their businesses. And I do think we're coming into a very good period where cross-border acquisitions will be something that we'll see.
Yeah, I mean, that's been a bit of a dream for many, and it seems very far away most of the time. But I take your point on making small incremental progress. I was catching up with the CEO of Federated Hermes Limited, and you may know him, Sagar Nusseibeh. He's based out of London. They've got about $800 billion in assets under management. He said he was impressed with the reforms taken by the British government. And he also said that London is making a comeback to sort of reclaim the center of the podium when it comes to financial centers, especially with the trade deals with the US, India, and the EU, maybe the Gulf in touching distance. Your reaction? You've spent a lot of time in London. You still go back regularly. You do business there as well. Is he onto something?
Yes. And I literally flew back yesterday from London. Listen, starts with it's the best financial center in the world. Given the language, the culture, everyone wants to live in London. I often tell the story that when Morgan Stanley asked me if I'd moved to London, if I went home and said to my wife, what do you think about moving to Frankfurt? It would have been a different answer if it was, what do you think about moving to London? So 20 plus years, our children were born there. They went through high school there, a wonderful place to live. But it has been in demise relative, not to Frankfurt or Paris or Dublin. I think they've lost out market share to the Middle East, to UAE, to Kingdom of Saudi Arabia, to Doha. And I think they're coming back. And part of that is a recognition that the banks are a key part, the domestic banks are a key part of the domestic economy. I wrote an op-ed in the FT a few weeks ago on ring fencing. Their reaction to 2008 actually hurt retail banks, hurt consumers, and made the system less stable rather than more stable. Undo it. It's okay. You made a mistake. Let's undo it. The bottom line is that I think the Prime Minister and the Chancellor of the Exchequer from the Labour Party have a better chance to change the attitude than the Conservatives, because who would have expected it, if you know what I mean? So I think the opportunity for the Prime Minister and the Chancellor to continue doing what they're doing, which is to celebrate the opportunity that London has as a financial center to make the economy of all of the United Kingdom stronger, to make the UK a magnet for expatriates to live there, to undo some of the damage about the non-dom legislation and some of the other things. I do think they're making progress, and we certainly saw it. We're seeing really strong performance in our Panmure Liberum business there. So there's definitely a turnaround.
I mean, here's what worries me about this push towards deregulation, which is being led by the United States. They want to further cut the regulatory burden. I mean, it sounds like a marketing term, but there is a reality that the regulation was put in place after the financial crisis because of learnings and conclusions and sort of a level of maturity that comes from it. So not every rule or regulation is necessarily bad, and there's the risk that you remove a lot of the learnings and you create new risks that could ultimately lead to similar outcomes. is that really the smart thing to do, to be unwinding some of that regulation, especially given the scale and the magnitude and the damage of 2008?
There's no one good answer to that, Youssef, as you know, but let me bring up two things. You had mentioned the interview with Jamie Dimon last week, and he said about the crack in the market that there were many regulators right in that room with him, and they were paying attention to it. If he's correct, regulators don't need a rule to look at the bond market and the damage it could do. It's the quality of the people. And I look back to the UK, under Mervyn King as the head of the central bank, every single deposit-taking institution in that country needed to be bailed out, other than HSBC and Barclays, by the government. It wasn't because of the rules. And if you look at the approval of Royal Bank of Scotland to acquire ABN AMRO in cash, not in equity, and the regulators allowed them to take their capital from 5% to 3.5% in order to do that deal, it was the execution. Now, rules matter, culture matters, but also the quality of the regulators in terms of how they enforce the rules. And I think that's the more important thing. Do we have an attitude that banks are good, that banks are smart, that if there are bad actors, they'll be weeded out? But we really want investment, we want growth, we want strong economy, we want successful people. It's an attitudinal thing. And it was about attitude that allowed Royal Bank of Scotland to fail. I'm sorry, but it was not regulatory rules. It was the lack of focus and the lack of execution on the side of the regulators that allowed Royal Bank of Scotland to, frankly, cost the government over $10 billion.
When you think back to 2008, Bob, at what point or what time did you know this is going to be really bad and really painful? Do you remember sort of an exact day and time where you're like, okay, where it really sunk in? That again, because obviously it was a process, right? It didn't happen overnight. But when was maybe a moment where you're like, wow, okay, this is bigger than anything I could have even imagined?
Again, I'm an optimist. So until Lehman weekend, I would not have seen a failure as systemic and as large. I didn't see how deep the problems were at AIG, for example, and at Lehman. But there were signs going through. And I think if I go through three or four times leading up to that I had to go, as you said, whoa. I think in the summer of 2007, there was the failure of the UBS money market fund in the U.S., which I think had grown to something like $30 billion in subprime mortgages leveraged up. There was the failure of the Bear Stearns asset management business, where you have to say to yourself, how can an asset management business fail? What are they doing in terms of risk? And obviously that led at Easter time to the collapse of Bear and JP Morgan taking them over. And that had to be, just very, very important. And then lastly, the BNP Paribas, the first time a money market fund had, quote unquote, broken the buck, where they clearly had securities in there that were not money good. I think that was toward the end of 2007 or very early in 2008, but before Lehman. So there were a number of things happening that I don't think anyone could say they were unprepared or should say it. But at the same time, I think the significance of that weekend with the collapse of Lehman Brothers, the rescue of AIG, which I think the economics in AIG were worse than anyone could have realized. And then making a decision for both Goldman Sachs and Morgan Stanley to become bank holding companies and have access to the window at the Fed stabilize things. But before AIG was rescued and before Goldman and Morgan Stanley were made bank holding companies, there were a few days there where I thought the world was going to end. And you'll look back and recall that in the first quarter of 2009, the economy absolutely collapsed. And we forget it because it was so short. But that first quarter of 2009, that recession was so deep and so dark. And the equity prices of all financial institutions just plummeted. It was absolute. I think the most scared I was in the first quarter of 2009.
Looking back, was it the right thing to do to let Lehman fail? I mean, if you could go back and if you were in charge, would you have handled it differently? I mean, obviously it's easier, hindsight, we get that. But let's just do a counterfactual here. Let's assume those conditions were in place. How would you have done it? Was it the right thing to do?
It's very hard to line up all the chess pieces. Like, if you'd saved Lehman and didn't save AIG, would it have been better? No. So, there's so many pieces to move, Youssef, but what I would say is there was a path to save Lehman. I'm not sure it was right or wrong, and we'll never know. I think everyone knew there was a path, but the Secretary of the Treasury had made so many strong decisions leading up into that. He played a blinder. And I think the action of Tim Geithner and Secretary of the Treasury Geithner and some of the other regulators around the world, I mean, there was no playbook, and it was a whack-a-mole, and there was one problem coming up after another, from Bear Stearns collapse to Fannie and Freddie to AIG, which was probably worse than all of them. So I would never go back with 2020 hindsight to anyone about how many decisions, like what would have changed if any one of those pieces was different. I think it's too hard. And I think the key thing there was the confluence of events in a very short period of time with Lehman, with AIG, and the realization that once Lehman had failed, it put both Morgan Stanley and Goldman Sachs at risk of having the same happen. So the rescue of AIG and the creating of those two institutions becoming bank holding companies were so strong. That's what kept things together.
The other story that kept you probably awake for many, many nights was the LIBOR scandal. This was massive, and Barclays, the bank you ran during that time, was involved. When you think back and sort of reflect, what do you think people misunderstand about what happened with LIBOR and how you navigated that crisis? I mean, it's because, again, this was the subject of a court investigation, and, they've made their judgments and they've put this to history. But again, today, with full knowledge of what happened and all the points of view, what would you say about it?
I think it was very pervasive across banks. And I think it was allowed, it was known by the regulators. I mean, the Bank of England was well aware of it. We'd had discussions that the core problem, Youssef, was very, very simple, which is the setting of LIBOR was setting the rate at which banks lend to each other, right? So where does Barclays lend to RBS? Where does RBS lend to Commerce Bank? And you take those banks and you take, 12 of 16 rates or whatever it was. Here's the fundamental issue. When the crisis hit, there was no trading between banks. No one had any transactions. The regulators knew that 100%. We were calling them every day saying, what do we put in for a rate? The other thing I would say, and we went to the regulators many times on this, Royal Bank of Scotland, which we now know was insolvent because they had a infusion from the Bank of England during, I think it was kind of July, August, September, because of all their problems, they'd run out of deposits and run out of cash. They were being subsidized by the bank, but they were still posting LIBOR rates at the lowest level. So the regulators were completely aware of the situation. And I think this was a little bit of, and by the way, on the other side, there were some bad actors at banks in foreign exchange and LIBOR and derivatives and setting the rates. And there were certainly some traders that were preferred. Their derivative book was going to get marked here, so they're encouraging someone else to do a lower rate. So it was a bit of both. But I come back to the issue, which is the fundamental issue in LIBOR was you were setting rates of how banks lend to banks. And there was no lending of banks to banks in the crisis. It stopped. So the regulators were well aware of that. And that's why there were so many calls from the regulators asking us how we were setting our rates. And I think most of the banks were given pretty honest answers, which is there's no lending, so we're doing the best we can.
The whole system froze up. And it probably means that this was one of the toughest, if not the toughest moment of your career.
I think, the whole setting of LIBOR and things like that was something that I would not have seen from my position either as head of the investment bank. And so I feel very comfortable because, like all of us in the bank, the Department of Justice in the U.S. looked at it, and the FSA looked at it, and there was never any question of an individual such as me being involved. I think the issue was this something that cast the banks as kind of bad actors altogether? And I think that's the trigger to some of the emotional reaction within the UK and Germany and other countries of, let's get those guys and provide biblical justice. In other words, are all banks bad, or are some good and some bad? But this was something that was going on at a lower level and at most of the banks that we would have known of.
Looking back, Bob, who had the most profound impact on your career trajectory? Let's zoom out for a moment.
Wow. There's no question in my mind that a gentleman named Bill Cook, who passed away just before the financial crisis in 2007, it was my first boss at a company called U.S. Surgical in Stamford, Connecticut, and was hired and recruited by Morgan Stanley and asked me to join him there. I started in the IT department, programming, and Bill worked there for many years. And to go full circle, when I became head of the investment bank and head of the asset management business at Barclays, he had retired. And I convinced him to come back and be kind of work with the executive team, work with me in terms of how could we build from that little small unprofitable BZW, how could we build a global investment bank and do it slowly, profitably, never miss a quarter of earnings? Bill Sully, and he was so helpful in terms of recruiting top people. And for me, in terms of identifying and motivating the senior team. And it was an incredible success in the years of Barclays Capital. We had 12 straight years of 20% compound growth in revenues and profits. Never missed a quarter of profitability, which is why we were so confident and so supported by our board and the regulators when we acquired Lehman during 2008. But Bill was a boss, a friend, a mentor, and the kind of person, as you know, that will tell me what I don't want to hear. I think that's
Everybody
the most
needs
important thing
like
about
that in their life.
You really need a person like that. Yeah.
Okay. How do you manage stress then, especially in high pressure moments? Any routines or philosophies that you've come to live by and that you'd like to share?
I work out every day.
Okay.
Workout sounds more dramatic than I meant that. I get some exercise every day. So yesterday when I landed back from London, the first thing I did is go to a gym. And I think being physically fit and paying attention to your sleep and what you eat and your health is probably the most important. I love my family, and we're very, very close. I think I would hope we would be as close as we are, no matter how we all kind of grew up. But the fact that we grew up for over 20 years with our kids, and Jennifer and I living outside of the U.S. in Tokyo and in London, and kind of being on our own, we're even closer today. And I think loving what I do, I think those are the three things that do it. So I don't think stress is a negative. Stress kind of gets you focused and gets you intense. But I love what I do. I count on the fact that outside of work, I have a great family. And I try and pay attention as much as I can to what I eat and how I sleep and in getting exercise.
Are you an early riser then? I mean, I used to be when I had my CNBC and sort of Bloomberg career. So that was, a good 20 years. And now more recently, now that I've had the privilege of this podcast, I don't have to get up at 4:30 in the morning anymore. How does it look on your end?
So what time do you get up?
I'm not going to say.
I am maniacally early. And the history of that is when I had my first big break at Morgan Stanley and I joined the fixed income group and I was actually trading. It was in the 1980s. There were no cell phones. There was no PC on your desk. There was no Bloomberg. So the competitive edge was getting in early, calling Japan to find out what was happening there as their day was closing, calling London to find out what's happening in Europe, and trying to get a step ahead of everyone else. So I would be the first one on the trading desk every morning. I'd get up very early, try and get to the desk by 6 or 6:30. This isn't a day, of course, when, equity markets were opening at 10 a.m. and, bond markets weren't as regulated, so a bit earlier, but I was a good hour ahead of most people coming into the office. And it was all to kind of find a way to get a bit of an edge because trading financial markets is kind of a zero-sum game. For every winner, there's a loser on every trade. So very competitive, and unsurprisingly, that fit me very well.
Yeah, I definitely don't want to play golf against you. It sounds like I'm going to be on the losing end of the bet for sure. Bob, this has been incredible. Thank you so much for your time and your insights, and look forward to catching up again very, very soon.
Yourself, I enjoyed it. Congratulations on having the courage to go off on your own and build your own business.
Thanks, Bob.
Thank you.
Thank you for listening to You're in Business. If you've enjoyed the conversation, like, share, and subscribe. See you next time.